Stocks turned red and headed sharply lower after the Center for Disease Control and Prevention confirmed a second U.S. case of the China coronavirus, putting the Dow Jones Industrial Average in the loss column for the week. In other words, we're being told that the coronavirus is so contagious that it moved from a Chinese market to the U.S. stock market and infected the S&P 500, the Nasdaq, the Russell 2000, and other U.S. indices, which were all down. It was all a surprise to me, as I thought a coronavirus was just a hangover from too many Mexican beers. But let's take a look at the damage that was done. The Shanghai Comp's worst week in 8 months. The S&P 500's worst week in 5 months. Most shorted stocks had their biggest weekly drop in 4 months. France's CAC 40 had its worst week in almost 4 months. The VIX had its biggest weekly spike in almost 6 months. High-yield bond prices had their worst week in almost 5 months. The Treasury yield's biggest weekly drop in 4 months. The yield curve's biggest weekly flattening in 2 months. The U.S. dollar's best week in 2 months. The yuan's worst week in 4 months. Copper's worst week in over 5 years. Oil's biggest weekly drop in 8 months, and gold's 6th weekly rise in the last 7 weeks. So, let's take a look. And we're looking at the 3-year weekly chart on the iShares Russell 2000 ETF, and the symbol is IWM. The close on Friday was 165.39. From that bottom there in late 2018, we had a bounce recovery to this level here, and we sort of went through this channel sideways for quite a while up until about November of this last year. And once it broke above, we headed up to this point here, which was not quite to the level, record level, that was back there in, say, mid-2018. Now, let's go down here to the MAC. What's going to happen from here? Well, a couple of different scenarios are possible. It might head on down and reflect back off of the slow line as it did here. It could continue on down as it did, say, here, or perhaps here and here. And that means either it's going to be a very bad decline, a moderate decline, or just a short decline. Well, that we don't know yet. To me, the possibilities are more likely in a short decline or a moderate decline. I don't see anything on the level of this decline here into late 2018. We do have the elevation up here, so it certainly has the stock market gravity that can pull it down, but I just don't see it in the cards, at least not yet. Into the histogram, we can see that this was a relatively low rise run, so I think it's going to be a relatively low end move on the downside. Here, into the price rate of change, the elevation isn't really all that significant either. Again, to me, it's just kind of a run-of-the-mill contraction. In the RSI, we're at 61.13, and it did come down fairly sharply here, but again, we'll have to wait and see. Into the stochastics, the fast line did move on down after reflecting up from below and then headed on down here, but we're still in that overbought territory. It's going to have to get down more close to that 50 or midline or below for me to believe that it's going to be anything worse than a run-of-the-mill correction. The volume doesn't bear anything out. And then into the Williams. The Williams is heading on down, and oftentimes the Williams will lead the other oscillators. So I think we have more downside to this. But I don't think that any news out there right now is indicating to me that we're going to have anything more than a pullback or a correction, and we've been waiting for this for quite some time. I actually hope it's a healthy correction, which would mean I might be able to get into some stocks, but I'm not real hopeful of that yet because I don't see anything in the charts that tell me that this is going to be anything more significant than just a run-of-the-mill pullback. We'll have to wait and see. And for today, that's ChewDog Charts. Thank you.